All right, let's dive in. Today we're doing a deep dive into the Boeing Company, ticker symbol BA. This is one of those companies, you hear the name everywhere, travel, defense contracts.
Yeah.
But what's really going on under the hood right now?
Exactly. And we've pulled together quite a bit of source material financial reports, those Q1 2025 earnings insights, recent news, analyst views, company info. Looking at the snapshot from our sources, the stock last closed at $200.32 USD, noted as being down about $3.43 or 1.68% on the day that snapshot was taken.
Right. And our goal here with this deep dive is really to cut through all that data, help you understand the key forces, the challenges they're facing, and the progress they say they're making so you can get a clearer picture of what's driving Boeing today.
Yeah, think of it like getting the essential takeaways distilled from the source material, a shortcut to being, pretty well informed on this complex company.
Okay, so let's start at the beginning. Who is Boeing structurally? Based on what our sources say. We know the name, obviously, but they operate across a huge spectrum.
They really do. The source summary points out they design, develop, manufacture, sell, service, and support just an incredibly wide range of things globally. You've got commercial jetliners, military aircraft, satellites, missile defense, human spaceflight tech, launch systems, the whole nine yards. And to manage all that, they're basically split into four main segments.
Break those down for us a bit.
Sure. You've got commercial airplanes, that's the one most people know, passenger jets, cargo jets, and all the support services for the airlines. Then there's defense, space, and security. That covers government contracts, military planes, weapons, satellites, their space exploration work. Global services is essentially their aftermarket arm. Support, training, parts, data analytics, maintenance for both commercial and defense customers. And finally, Boeing Capital. That's their financing segment, helping customers get leases or loans for Boeing products.
Got it. And the source notes they were incorporated way back in 1916, based in Chicago. Now, a key insight the source points out is this idea of a wide economic moat. For anyone less familiar, that basically means they have these big, durable competitive advantages protecting their market share, their profits. What makes up that moat for Boeing?
Well, the source highlights the number one reason. It's the global duopoly in large commercial aircraft. I mean, for the big passenger and cargo jets, you're pretty much looking at Boeing and one other major player worldwide, Airbus.
Yeah, it's not like you could just decide to start building jetliners tomorrow. The barriers must be enormous.
Oh, absolutely immense. The source points to, first, just the massive amount of capital needed, then the incredibly complex engineering, and critically, getting through those stringent regulatory certifications like from the FAA. These aren't small hurdles. They effectively block anyone new from jumping into this space.
And once an airline is using Boeing planes, they're kind of locked in, aren't they?
Pretty much. The source calls out the high switching costs. Think about it. If your pilots are trained on Boeing, your mechanics know Boeing, your operations run on Boeing models. Switching to a competitor means huge costs. Retraining, new infrastructure, disrupting everything. It's a massive undertaking for an airline to just switch fleets wholesale.
So that gives them huge leverage in commercial. But this moat, it goes beyond just passenger jets.
Yes, the source also mentions their strong position in defense. That's built on specialized, often long-term government contracts and proprietary tech that's unique to Boeing. Hard for competitors to break into that.
Right. And despite all the recent challenges, and they've been very public, they still have a massive amount of business already lined up.
They really do. The source material really underscores this. It mentions a backlog of over $545 billion. That includes over 5,600 commercial airplanes waiting to be built and delivered. That's not just a number. It represents years of production, years of revenue. It shows there's still strong underlying demand for their core products, even with the current issues. And the source explicitly says, while challenges exist, those fundamental competitive advantages, the things that make up the moat, they're considered intact.
Okay, so that huge backlog, the duopoly,
Yeah.
that's a powerful foundation.
Ah,
But let's zoom in on recent performance. The source has insights from Q1 2025 earnings reported back in April. How did that quarter shape up, especially after all the focus on operational problems?
well, the source highlights Q1 2025 as showing significant operational and financial improvement compared to Q1 the year before. Revenue jumped quite a bit, hitting $19.5 billion, and that was mainly driven by getting more commercial planes delivered.
Deliveries are key, obviously. How did that translate to the bottom line? Were they still losing money?
Their losses narrowed significantly, yeah. The GAAP loss per share was down to $1.16, and the core loss per share, which adjusts for certain things, improved meaningfully to even 49 cents. The source actually describes Q1 overall as a solid quarter. suggesting, maybe the recovery plan they've put in place is starting to show some real results.
That operational improvement sounds crucial. What specifics does the source give on production rates and, importantly, quality initiatives? We've heard so much about quality control.
Yeah, this is where the earnings details get interesting. For the 737 program, the one under the microscope, they're gradually increasing production. The source says they were in the low 30s per month, and they're on track to hit 38 per month this year. The plan down the road is to ask the FAA for permission to go up to 42 a month. But, and this is critical, that's contingent on them proving their production system KPIs. Those key performance indicators are stable and reliable.
Okay, so the FAA is watching like a hawk. Rate increases depend on proving quality is stable. What about the 787 Dreamliner?
For the 787, they've stabilized production at 5 per month, and they expect to ramp that up to 7 per month this year. Again, the report says this is supported by strong KPIs, including something called final ticketing, which sounds like getting all the final paperwork and certs done right before delivery.
And specifically on quality itself, what progress did they note?
The source points to significant cuts in rework hours and something called traveled work on the 737 line. Rework hours down about 25%, and traveled work that's like parts or tasks needing fixes off the main line down roughly 50% compared to before the strike last fall. They've also brought in a new travel-ready process, trying to make sure things are right before they hit final assembly. And importantly, customer reports are cited indicating better aircraft quality. That's a key sign these efforts might be working beyond just internal numbers.
That does sound promising. What about fixing issues on planes built earlier that were maybe sitting waiting for fixes?
They report progress there too, yeah. Reworking those older 737s and 787s that needed modifications. This has apparently let them close some shadow factories, those temporary spots set up just for rework, and they plan to reduce buffer inventory as defect rates fall. The source mentioning 787 KPIs being all green suggests better quality coming right off the line now.
Okay, and outside of commercial, how did the defense side do?
The defense, space, and security segment, it showed an improved operating margin in Q1, suggests things are stabilizing there. Importantly, they held their EAC's estimate at completion on their fixed-price development programs. That means they haven't had to publicly increase their cost projections for finishing major defense projects, which is a good sign for stability, especially on those tricky long-term government contracts. The source also highlights a big win, the transformational BF-47 contract, supposedly secures their fighter jet business for decades.
Okay, good context. Let's shift to the financials. The balance sheet, cash flow, how does that picture look according to the source?
The source suggests the balance sheet is still solid. End of Q1, they had $23.7 billion in cash and short-term investments, plus access to credit lines. So liquidity doesn't seem to be an immediate worry. Total debt, though, is substantial, listed at $53.62 billion.
Right. And cash flow, particularly free cash flow or FCF, that's been a huge focus for investors. What did Q1 look like, and what are they projecting going forward?
Q1 2025, they actually used free cash flow usage was $2.3 billion. However, the source notes this was better than anticipated. They expect Q2 FCF usage to be pretty similar to Q1. But here's the key part. They have a strong expectation for the second half of 2025 to turn positive and then accelerate.
What's driving that expected H2 turnaround?
Primarily, it's expected to come from ramping up production rates and deliveries. More planes out the door means more cash coming in from customers. They also anticipate favorable customer receipts, maybe timing of payments, in the back half of the year. Now, the source does add a caveat. The full-year FCF range is unchanged for now. It depends on things like getting clarity on China deliveries and tariffs. Higher investment levels, like for the 777X program, are also kind of an offset, holding back near-term cash generation a bit.
And wasn't there something about selling off a part of the business?
Yes, exactly. The source mentions a planned divestiture, selling off parts of their digital aviation solutions business. That's expected to bring in a significant chunk of cash, estimated around $10 billion in net proceeds. That would definitely boost their cash position.
Okay, so we've got the market strength, the Q1 operational improvements, the projected financial recovery. But every deep dive needs the other side. What are the big headwinds, the risks, the things that make up the bear case, according to the source material?
Right. This is where the external pressures and the ongoing internal challenges really come into play. The source is pretty clear on several key risks. Geopolitical risks and tariffs, that's a major one. Specifically, retaliatory tariffs from China are directly hurting planned deliveries over there.
How big a deal is China for Boeing's commercial side?
The source says China accounts for roughly 10% of their commercial backlog. That's significant. They had around 50 deliveries planned for China for the rest of this year. But because of tariffs, some customers are reportedly refusing to take delivery. So now Boeing is looking at remarketing about 41 planes already built or in process that were meant for China. And they're talking to the US government daily, trying to stress the impact, emphasizing the industry as a major exporter. The source does note the direct input costs from tariffs are manageable, less than $500 million dollars a year, partly offset by duty drawback. But the lost deliveries are the bigger issue.
So geopolitics hitting deliveries and cash flow directly. What about operational issues still lingering, despite the Q1 progress?
Yeah, even with reported improvements, the source mentions ongoing operational and supply chain challenges needing diligent management. Specific things like an SPS fasteners fire are cited as examples needing careful oversight. They're also working through 787 seat certification issues, which are expected to hit deliveries throughout the year. So specific hurdles keep popping up. And just managing buffer inventory effectively is still noted as needing focus.
And delays getting new models certified.
Yes, the timelines for certifying the 737 MAX variants, the NACTA 7 and the NACTA 10, are unchanged from what they expected before, according to the source, which means those delays continue. Those planes won't enter service as soon as hoped, impacting delivery schedules and revenue for those specific models.
We also touched on program execution risks earlier, even with stable defense EACs in Q1.
Right. Just because Q1 was stable doesn't mean it's guaranteed. Those big fixed-price defense programs require ongoing careful management to avoid future cost overruns or delays.
And the cash flow, projected to recover later, but still negative right now.
That's right. The cash usage in Q1, and expected again in Q2, reflects this mix of ongoing challenges, the needed investments in programs like 777X and certifications, and the hit from delivery delays like China or the 787 seat issue. Getting to positive FCF really hinges on successfully ramping up production and deliveries later this year.
Which loops right back to needing sustained quality improvements.
Precisely. This might be the most critical ongoing challenge. The source implies that consistent quality improvement is absolutely vital for regaining full trust, especially from the FAA. Their ability to increase production rates further, like going past 38 a month on the 737, is explicitly tied to the FAA reviewing and approving based on sustained good performance metrics. Any backsliding, any new quality problem could seriously derail the recovery timeline and their ability to actually deliver on that huge backlog.
And you really see how sensitive the market is to quality concerns in the recent news headlines the source included. Mentions of a Dreamliner crash investigation in India around June 12-13th, the CEO canceling a Paris trip, the stock dropping after that crash news, Air India crash reigniting safety worries, even a law firm mentioning a potential fraud investigation opportunity on June 12th.
Exactly. Those headlines, as reported in the source, just show the intense public and regulatory spotlight they're under. Even as they report internal progress, any external event, any incident anywhere can immediately bring safety concerns flooding back and hit the stock. It really highlights how fragile that confidence in their quality control still is right now.
Okay, let's try to wrap this section up by looking at valuation and what analysts are saying
Yeah.
based on the source data.
Sure. So the source noted the price at $200.32. The source itself provides a fair value estimate of around $180.05. But context is key here. The source mentions this estimate was calculated when the share price was lower at $172.33. So at that point, the stock was actually trading slightly below that specific estimate. Now at $200.32, it's trading above that particular $180.05 figure from the source.
Okay. And how do analysts generally see it? What's the range of opinions in the data?
The source gives an average analyst price target from the last 6 months of $209.50. That gives you a general sense. But it also lists specific recent analyst actions showing quite a spread. For instance, Mealy upgraded to buy $204 target back in March 25. Deutsche Bank raised their target to $215 in Jan 25. But then you have Bernstein cutting to market perform $169 target in October 24. Other targets from late 24 included Susquehanna and Robert W. Baird, both at $200, JP Morgan at $195, Citigroup at $209, but Wells Fargo way down at $109, and Wolfe Research reiterated outperform at $210 in September 24. So quite a range.
Wow, that Wells Fargo $109 target really stands out compared to the others clustering mostly around $170 to $215. What might an analyst with that very bearish view be focusing on from this source material compared to the more optimistic ones?
That's a great point. That range is fascinating. The source doesn't spell out the reasoning for each target, obviously, but someone landing at $109 is almost certainly putting much more weight on all those downside risks we talked about. They're likely modeling prolonged certification delays, maybe bigger execution problems on development programs, seeing the supply chain issues as more severe or lasting longer. Definitely worried about further geopolitical hits, and critically, probably skeptical about how quickly Boeing can really regain that regulatory confidence and achieve sustained quality. They might see the projected H2 cash flow recovery as much more uncertain, more precarious than the company presents it.
So it really comes down to how much risk you assign to things going wrong versus how much credit you give the signs of progress.
Exactly. It shows how different analysts, looking at the same basic facts from the source, can reach very different conclusions based on their underlying assumptions about probability and impact.
And the source also mentioned some recent insider selling.
Yes, it just noted that several Boeing officers sold shares in May 2025. The source just reports the fact, doesn't give context on reasons or amounts relative to their total holdings.
Okay, so let's pull this all together then. Based on the source material we've explored, Boeing is clearly a company with these immense, durable competitive advantages that wide economic moat. Global duopoly, high barriers, high switching costs, strong defense side, all backed by that massive order book.
And based on the Q1 insights, they are reporting tangible operational and financial improvements compared to last year. Signs the recovery plan might be working. Specific metrics point to better quality control efforts, stabilizing production rates, with plans to increase. And they're projecting that significant free cash flow turnaround in the second half of this year.
However, and it's a big however, the source material makes it crystal clear they are still wrestling with significant challenges and risks. Geopolitics, like the China tariffs, are having a real impact right now. Ongoing operational and supply chain snags persist, certification delays drag on, program execution risks are still there, and maybe most critically, that ongoing crucial need to rebuild confidence through sustained quality improvements and regulatory trust, a process that's under intense scrutiny and vulnerable to setbacks, as those recent headlines show.
Yeah, it's really a story of inherent underlying strength and definite signs of recovery battling against these significant persistent headwinds, and that fundamental need to restore operational excellence and, frankly, trust.
We've really tried to dig into the financial data, the earnings details, the market position, the specific risks, the analyst views, all presented in this stack of sources to give you this comprehensive snapshot. Understanding all these moving parts, the market power, the detailed operational fight, the financial trajectory, the external risk, hopefully helps make sense of the complex picture that is Boeing right now and helps you contextualize the headlines you see.
It really does illustrate there's no simple yes or no answer here. It's a company in a really critical phase, balancing those strengths with this fundamental need for execution and regaining trust.
Absolutely. And as you kind of digest all this information from the sources, it really leaves us with this key question to mull over. Can Boeing successfully navigate these really deep-seated operational and quality challenges fast enough to truly capitalize on its powerful market position and that massive backlog? Or is the path to full recovery going to be longer and maybe riskier than current projections suggest?
That is the crucial question indeed.
Well, we hope this deep dive into the source material on Boeing has been valuable for you. If you found this kind of analysis helpful, getting insights distilled right from the data on complex topics, please make sure you subscribe to this channel and hit that bell icon. That way, you won't miss out on our future deep dives, all designed to get you well informed, fast.